Today is the 10th of August, 2024, and welcome to this session of the Academy of Family Physicians of India, Continuing Professional Development Group about financial literacy for doctors. How do you assess, diagnose, and make your way to more wealth creation? We have Sahil Bhargava with us, who will be talking about it, and then it will be open to questions in the second half. Without further ado, I would like Dr. Roshni Jan Ganguly to introduce the speaker, please.
Good evening and good morning, everyone. It really gives me great pleasure to welcome you all for today's session on financial literacy for doctors. Now, more often than not, as healthcare professionals, our primary focus is on patient care. But it is equally important to manage our personal and professional finances very wisely. And this particular session is designed to equip you with the essential financial skills and knowledge, empowering you to make informed decisions that will secure your financial future. It also gives me great pleasure to introduce our speaker for today, who is Mr. Sahil Bhargav. He has extensive expertise in financial services, working at top institutional investors, including Apollo Global Management, where he worked in the firm's flagship US private equity team and was ranked the top associate in his class. His career has spanned public markets, private markets, and retail lending. Today, Sahil is running Bharosa Club, a firm focused on helping retail investors to make better investment decisions. The company launched its product in April 2023 and today analyzes over $200, 200 million US dollars of investment assets for its clients and has helped its members lower their fees paid by over 30% and increase their annual returns by over 1%. So welcome, Mr. Sahil Bhargav, and session is over to you.
Thank you, Dr. Roshni. Thanks for that lovely introduction, and gives me great pleasure to host this session for you all. And as Dr. Roshni pointed out, you guys, are in the business of taking care of patients' bodies and keeping them healthy and keeping them fit and diagnosing problems and treating problems. And actually, there are striking parallels between what you do and what you should be doing also for your personal finance and your financial assets. In fact, if you even look at the word we use for your savings, you may have heard the term investment corpus. So corpus actually comes from the Latin word for body. And so, there is a striking parallel there itself. And my goal in this presentation is to show you that, a lot of the techniques that you use for caring for a physical body of your patients should actually be applied to your investment corpus as well. And that's what the presentation is going to cover. And my promise to you here is that if you guys internalize the framework and apply the framework that I'm talking about here today, I'm extremely confident you will create additional wealth for yourself going forward in your personal finances. It's not easy to do. I recognize that, but I'm going to show you how to do it and also tell you why I'm so confident that this will create enormous amounts of value for you if you internalize it. So with that, I'm just going to dive into the presentation and we'll take questions at the end. So if there's any doubts or things you want to explore, happy to do that after the prepared remarks are covered. Okay, so with that, let's jump in. So I was very strident in what I said about, look, if you internalize what I'm talking about, I think you're going to create more wealth for yourself in your personal finances. How can I make a statement like that? How can I be so sure about that? And that's because it's not theoretical. So as Dr. Roshni mentioned, we launched a product at the startup that I co-founded called Bharosa Club, which has now analyzed upwards of 200 million US dollars of portfolio value for our clients in a little over a year. And over that period, we've seen dramatic changes in our clients' portfolios. And this is utilizing all the techniques I'm going to talk to you about in my presentation today. Now, importantly, you do not need to use our technology or product or any of this to implement the techniques I'm talking about. You can do it on your own. Our technology just makes it very, very easy to do. So this will apply to anybody, no matter what geography you're in, whether or not you want to use our products or not. This should be extremely applicable to you, and you will still get performance improvements. So what kind of performance improvements did we see in our clients' portfolios? So we reduced their fees by 30% in a little over a year. And we saw their investment returns increase by 1.3% per annum on an annualized basis. And that may sound like a very small improvement, but it's actually massive. And the reason it's massive for the younger doctors on the call is because due to the power of compounding, this is a significant change over 20, 30 years of investment returns. And for people that are closer to retirement age or perhaps retired, a 1.3% increase in your investment income means 10 to 20% more investment income for you to enjoy in your day-to-day life. So no matter where you are in your life cycle as an investor, this is a very, very meaningful increase in investment performance. And all of it is done through the techniques I'm going to talk and cover here. None of it is done from us giving advice. We are not rocket scientists. I have no idea what the stock market is going to do tomorrow, any more than you do. It's more about using data to help improve the quality of the decisions you make going forward.
So what is that reduction in 30% fee?
The reduction in fees, I'll cover a little bit of that in the presentation itself, but it's essentially being much more aware of what you're paying to whom and whether you're getting value for money for those fees. So we'll cover that a little bit later. But if there are more doubts about it, we can cover it further in the Q&A. Okay,
this is something, sir, which you're talking is different from the other investments. Because
in what sense?
I just wanted to know this investment or creating wealth is something different from the regular investment where people invest in real estate, stock market.
I think we'll come to these in the question Q&A session. If you can just put these questions in the chat box, that'll be good.
Yeah, sure.
And let this flow because this presentation is only for about 20 or 25 minutes, not more.
Yeah, it's a pretty short presentation. So, so before we get into how we've done this, and how you can do it yourself, I'd like to cover how you practice as a physician. So when you get a patient that walks into your office, your practice, and is complaining about certain symptoms, how exactly do you treat that patient? You follow a process, and I'm going to argue that process you follow should exactly be applied to your investment portfolios as well. So the first thing you do is you run a bunch of assessments, right? You can't just look at a patient comes in complaining about a headache and say, okay, you have a cluster headache and you need to do X, Y, or Z, right? You need to investigate, maybe run some tests, get some numbers back. So you first do an assessment. Then basis that assessment, you get your reports. You look at reference ranges versus the values that are determined by your test. And you're then able to diagnose based on a combination of the symptoms that the patient is expressing, as well as the values of whatever tests you've looked at. And you're able to diagnose the problem. Then you have a good understanding of what's wrong with the patient. And only then can you come up with a prescription and a care plan for the patient. And using this, you're able to keep your patients healthy and fit. What I'm going to argue here is that our portfolios don't get the same standard of care. Some of you may be surprised by this statement. Some of you may agree with the statement. But for the people that are surprised by the statement, I'm going to ask you the following questions, and for you to understand if you really know your portfolio as well as you think you do. So, do you have a good sense of how your portfolio is performing versus others? I'm sure we all have the experience of going to a party where you're hearing people talking about, oh, I made this much on this stock or that much on my property, my house, and then we feel like, hey, am I getting left behind? Am I keeping up with everyone else? I feel like I'm not doing all these things, and I was talking with Dr. Kamlesh before the session, and he said this fear of missing out is very real. But the reality is we can actually look at data to see if we're getting left behind. And I'm going to talk to you in this talk about having the data to actually know, are you getting left behind? Is there a cause to be afraid? Do you honestly feel like you understand what's working and what's not working in your portfolio? You may have tons of different assets, like Dr. Roshni was saying, that she has varied investments across fixed deposits, across real estate, across these other asset classes. Do you have a good understanding of where you're making good money and where you're not making good money? I would guess that most of you don't. And that's okay. We're going to talk about how to do that. Then, do you have a good understanding of where you're paying fees and if you're paying fees and to whom? And if you're getting paisa vasool or value for money for those fees. Some of you may be surprised that you're even paying fees, right? But the reality is, if you're investing in many asset classes, you will be paying some fees. For example, if you're engaged in real estate, you may be paying stamp duties and taxes. If you're invested in mutual funds, you're likely paying a commission on that mutual fund to the person that sold you the mutual fund. You're paying a fee to the mutual fund house. A lot of these fees we don't actively pay. They're deducted from our return before we even see it. So we don't even know how much we're paying. Then when you roll up your portfolio, you're buying individual stocks, individual mutual funds, individual assets. When you roll up the portfolio as a whole and you look at it, do you understand what you're betting on? What makes your portfolio different from everyone else's? How much risk are you taking? How big are these bets? And if those bets are working or not? Again, I would argue that most of you probably don't know because you're not taught how to do this and it's actually difficult to do. But I'm going to tell you how to do it and explain how to do it. And this is not your fault. No one is practically doing this in the market. And this is how we added value to our members, by making it easy for them to do a lot of these things. So what's the problem? The problem, in my contention, are the tools that we have to assess our portfolios. So I'm showing you a screenshot here of the top used mutual fund app in India. You've all who live in India and are investing in India have heard of this company. It's a company called Grow. And this is a picture of their mutual fund dashboard. So here you see a listing of funds along with rupee gains and rates of return. So this may give us a false sense of confidence that we understand how we're doing. For example, I can see a 29.4% return here in the first fund. That sounds pretty high, but I would argue that we actually have no information to conclude anything meaningful on this page. And the reason why is we don't have a reference range. If I just gave you one number and I said a patient's hemoglobin A1C is 6.2, would you be alarmed, or would you be happy, or would you be neutral? It depends on the context. If that patient previously had an A1C of 5.5, then maybe you would be alarmed. If that patient was at 7.0 and reduced it to 6.2, maybe you'd be happy, right? So context really matters. And here we have no reference range provided for evaluating any of these numbers. We don't even know what period this return is for. It's not displayed to us. These funds could all have different start dates and end dates. How are we going to draw conclusions about what's working and what's not working? So what is the reference range for finance? How are we able to look and get an understanding of whether we're doing well or not? So we have published reference ranges. You've all probably heard of a lot of these things. So if you've heard the term S&P 500, Dow Jones Industrial Average, BSE Sensex, Nifty 500, Nifty 50, these are indices, and there are lots and lots of indices available in the market. These are basically collections of stocks that enable investors to understand how the average investment has done in different sectors, in different slices of the market. There's an index, for example, in healthcare in India called the BSE Healthcare Index. So you can understand how the healthcare sector is done on average. And these are the reference ranges that you can look at to answer your questions about your portfolio, to answer the questions of, am I keeping up? Am I actually getting left behind? Are my friends at my party just talking about their winners and not mentioning their losers? Is my FOMO warranted or not? These are the sources of information that are going to help you do that. And just like with any test, it's not enough to just run the test. You need to know which test to run. And this is a critical sort of thing to learn and take away from this presentation. You're going to have lots of indexes to look at and to compare various data points with. Not enough to just look at any index. You have to pick the right index. So I'll give you a concrete example here. Let's say that I held DSP, Pharma and Healthcare Fund in my portfolio, and I wanted to assess, is this fund doing a good job in my portfolio? So I need to actually get a little more precise about what exactly I mean by, is the fund working? So there are two potential questions I could be asking here. And this is going to illustrate how to go about picking the right index to look at performance by. So for example, one question I could be asking is my fund manager doing a good job? Right? So here the question I'm asking is, clearly this fund is going to invest in healthcare companies, right? It's in the name. So when I picked this fund, I knew it was going to invest in healthcare. So when I look at judging the fund's performance, I have to do it relative to what I hired the job for, right? If you hire someone to build you a 2-bedroom bungalow as a holiday home, you're not going to compare his work to the Taj Mahal, right? You have to compare his work to whatever you expected. So similarly, to answer that question, we're going to compare the fund manager's performance to the healthcare index. So there's a BSE healthcare index. These charts I'm showing you are all freely available. There's a site called Money Control in India, and there are other sites in other geographies where you can just look up this information for free. And you can look at different time periods and see. Maybe I held this fund for a year and a half, and I want to look for a year, and I want to look at the performance of this fund over a year. And I can see, did this fund actually do a good job? Did the manager deliver paisa vasool or value for money to me? So I can see on this chart, for example, the two lines, the blue line and the gold line, are basically on top of each other. So the fund manager kept pace with the market. He didn't do a great job. He didn't do a bad job. He kind of did okay. Now, there's a second question I could ask, which is perhaps even more interesting. Was healthcare the right fund category to buy, right? I chose to buy a healthcare fund, but was that decision right? So here, for example, I need to judge my fund not versus the healthcare index, because I'm not trying to measure whether that was the fund manager did a good job. I'm trying to measure, did I make a good decision to invest in healthcare? So the right way to do that is to look at the total market. And the closest measure we have of the total market in India is the Nifty 500. It consists of the 500 largest companies in India and represents a good index to look at the overall market performance. When I compare these two charts, again, the blue chart, the blue line is ahead of the gold line. So I can conclude that it was a good decision to be in healthcare. So this is going to help me answer fundamental questions about my portfolio's performance, looking at benchmarks and measuring things to know what is working, what I'm doing well, what my fund managers are doing well, what they're doing badly. And performing this activity on your portfolio is going to give you knowledge about what's working and what's not working. Okay, so now, what about identifying bets in the portfolio? One of the things I covered in the earlier slide was none of us have any idea what we're betting on in our portfolios. We buy our mutual funds at one by one and different amounts. And when you add up all these things together, what does the portfolio actually look like? For example, I could think I'm betting on healthcare because I bought a healthcare fund, but I may not actually realize that that healthcare fund is tiny in my portfolio. And actually, I have a huge exposure to IT technology. So I'm actually betting on technology because we do these things over long periods of time and no one tracks how these things are changing. So one of the things we highly recommend people do is get a sense of how their portfolios roll up together and compare to the broader market. So what I'm showing you on this page is the Nifty 500's exposure to various sectors. So you have, for example, financial services comprising 28% of the index, the Nifty 500. Now, all this information is publicly available. You can just search for it, Nifty 500, sector composition. If you're in the US, you may want to look at the S&P 500 or the Vanguard total market, that various indices you can look at. You want to go with a broad index that tries to track a large section of the economy. So when I look at my portfolio, how does it compare to this is the question I need to ask when I'm trying to evaluate what I'm betting on. So if, for example, I look at my portfolio and a lot of the tools that we use to invest will have this information about what your sector mix looks like. So for example, Grow, which is a mutual fund app in India again, will have your sector mix. So you can look at that and compare it to this. So if I'm 40% in financial services, then I'm making a big bet in financial services. But if I'm 28% in financial services, then I'm in line with the market, right? So doing this, you're able to understand what needs to work for your portfolio to work. And then you're able to ask yourself the question, do I want to make these bets, right? A lot of the improvement that we are seeing with our customers is coming from this, them asking the questions that we are alerting them to and them making decisions based on that. There was a customer, for example, who we told, you have a big bet on large cap companies. Is there almost all your portfolios in large cap companies? Is there a reason for that? And the customer said no. So they balance their portfolio to reflect the market more closely. But there may be reasons you want to make the bet also, right? So this gives you the power to make sure your portfolio expresses what you're comfortable with. And that's going to create all the difference going forward. Okay, so I think there was a question about this fee topic earlier. So hopefully this addresses it. So when I say quantifying fees, what do I mean, right? What are these fees? The most dangerous kind of fees are the fees that you don't remove your wallet to pay. When you remove your wallet to pay something, like for example, you're going to pay your taxes at the end of the year, right? You're very cognizant of what you're paying because you actually have to actively pay them. When you go and do a stamp duty transaction, the fee is right in front of your face, right? You're not going to forget that fee. So those are less dangerous than fees that are collected without you even knowing. And so they're often collected directly from your investment value. and they are lower your return. And so these are the dangerous ones. They typically arise from funds that you hire to manage your money. So this could be a portfolio management service. It could be a mutual fund. It could be a hedge fund you've invested in the US. It could be a private equity fund. I worked at a private equity fund for a long time and a hedge fund. And the way it would work for our investors is we would give them their rate of return after deducting our fees. So they would see their fee in a little number in their statement, but it's not top of mind, right? And you can easily lose track of these fees. So, if I were to give you an analogy, would you ever hire someone to do a job and not know what you are paying them and not seeing if you got value back based on what you are paying them? The answer is surely no. Even for a small little job, you want to make sure you get value for money. But with your life savings, you got to do the same thing. So what we're saying here is pay attention to the fine print, what you're paying in fees, periodically review the fees you're paying, who they're going to, and see if you're getting the value that you expect from your fees. Okay, so the next point that I'm going to make is once you have all this data, now it's time to diagnose and treat, right? So maybe you have got some key findings. So like, for example, maybe you found out a fund manager wasn't doing his job, right? How do you react to this? How do you improve going forward? So what I'm showing you on this page is an actual screenshot of what our customers get when we identify something that's not working in their portfolio. So what you will notice here, hopefully you can read this. In case you can't, I'll just read some of it to you. But what you should notice here is we don't have a recommendation. We don't say that you should exit this fund. And the reason we don't do that is we don't have a crystal ball. We have no idea what's going to happen to this fund going forward. We're not in that business of giving advice. And honestly, most people that give advice don't have a much better idea than you about what's going to happen in the future. Because if they did, they would be billionaires. If you knew what was going to happen in the future, you'd really be a hero. So what this says is it gives you a case for why you may want to exit and a case for why you may want to make no change, right? And then you yourself can decide what you want to do with your personal decision, right? So for example, here we say why you may want to exit. Your fund has failed to beat its benchmark. You have no reason to expect this underperformance to change in the future. There was no reason you went into this fund. You don't know the fund manager. You don't have a view on it. So you have no reason for it to expect it to change. Why you may want to make no change? Because performance can change. If you believe in the fund manager strategy, you may want to keep holding, right? And what this does for our customers is you may think there's no value to this because we're not making a decision for them. But what this does is it gives you ownership of your decision. You now know a fact that this fund was not performing. You're now forced to take a decision and you're forced to own that decision. And by owning that decision, if you realize that 3 months later, this fund is still not performing, you'll better be able to react. And you say, I gave this fund a second chance. It still didn't work. Maybe now I'll sell, right? So by owning your decisions, you're going to become more aware and it's going to help you improve the quality of your decisions going forward. So here's the little secret about the hedge fund industry. These are professional money managers. You know what their batting average is? The top hedge fund manager, an absolute rock star in the industry, will only get 60% of his calls correct. 40% will be wrong. So that should give you a lot of comfort that you also can make mistakes. The key is not, being, super good and getting every decision right. That's not realistic. The key is just doing better than you were in the past and bringing awareness improving the quality of your decisions will help you improve your strike rate in the future. You'll feel more in control of your portfolio, and that's going to pay off in the returns you can expect in the future. And you'll see that performance trickle through in your portfolios. So I know what I've covered does not seem easy, and it's probably pretty daunting to many of you, but I would argue you have to do this. This is not optional in my point of view. And the analogy I always drive to people is that when you go out for a meal, most of us will check that restaurant bill before we pay it. We will make sure we weren't overcharged, and that's for maybe a $20 meal, $30 meal, 2,500 rupee meal, but for our life savings, that could be 2.5 crores. Because we've not been taught how to do it, most of us fly blind. And because, yes, it is harder to do for our life savings, most of us fly blind. But yes, it's harder, but the payoff is so much larger. The other reason many of us don't do it is we expect others to do it for us. Arey, I hired an advisor. What is his job? Isn't he supposed to do this for me? The system will not do it for you. The system does not care about your assets more than you do. No one cares about your hard-earned assets more than you. You worked for them. So you should gradually develop the confidence to start doing these things and monitoring your portfolio going forward. And the reason the system won't do it for you is that the system is not incented also to do it for you. Particularly in India, most of the advisors that are out there don't actually get their money from you. They get their money from the mutual fund companies who give them the money out of your return, right? So who's paying the bill at the end of the day? The mutual fund companies are paying the bill. So they're not interested in catering to you as much as they're interested in catering to the AMCs. They want to sell you funds that are doing pretty well, but also give them, so that you don't raise questions, but also give them good commissions, and of course there will be very upright advisors, there will be less upright advisors, but at the end of the day, an advisor also has to make the economics work for themselves. And if a mutual fund company is not going to pay them for a low cost mutual fund, they will not show you that low cost mutual fund because they won't make any money off of it. So even the most upright advisors, could be very good people and all, their interest is different than yours. So there is an alignment issue. The other reason you must do this is it will make a huge difference. This is your life savings, and the attention you put on it will be paid back in spades. And I recognize that it's hard. And, that's why we created Bharosa Club, to make this easy for people. But even without the technology, even in geographies that we don't service, we're only in India, right? We're only in mutual funds. We don't do this for stocks. We don't do this for real estate. We don't do this for anything, right? Other than mutual funds. And in India, you can still do it. You can still do it, and you don't need to do it that frequently. Every 6 months or a year is enough, and you will reap very strong rewards from it. So that is my sort of appeal to you guys, that treat your life savings like you treat your restaurant bill, because not doing so is very logically inconsistent, right? So, and the payoff is massive. So this is one of our longest customers. Even before we launched, this person, we were working with this person to help us develop the technology as a beta customer. And so he's used us for a long time. And you can see the enormous improvement in his portfolio. And he's done this all on his own. Our technology has just alerted him to things that aren't working, but he's made the calls. So you guys can do it. He's not a financial expert. He's just presented with data, and he's able to make decisions based on that data. So the stock chart is the amount of his portfolio that he's paying in fees every year. It started at around 1.8% of his portfolio is being lost to fees. It's dropped to 0.31%. You can see the performance also has gone from deep in the red to mostly in the green now. This is all versus market. We benchmark everything relative to the market, so the indexes. So that's what's possible if you guys follow these principles and put them in place. You'll keep your investment corpus healthy, just like you keep your patients healthy. So hopefully this was helpful. And with that, I'll open it up for any questions that came in.
Thank you very much, Sahil. Very interesting
My pleasure.
presentation.